Hi, this is Ashish Shanker, Head Investments at Motilal Oswal Wealth Management. I am happy to present to you our next in line series of Know Your Fund Manager. Today is the first edition in the alternative investment space. I have with me a very special guest, Mr. Sharad Mittal, who's our Head of Real Estate at Motilal Oswal. He has more than 16 years of experience in the real estate space. Now, I know this is an asset class which Indians love. However, this is a space which has been pretty headwinded and there have been a lot of challenges over the last few years. So, Sharad is here to talk us through about the real estate industry and how he sees trends shaping up. Also, we'll gather his thoughts on how to invest in the real estate sector because he's built a very successful practice here at Motilal Oswal and manages close to 2100 crores of assets. So, Sharad, welcome to the show.
Thanks, Ashish. Thank you very much.
So first of all, I'd like to congratulate you for building such a wonderful business. I mean, you built it from scratch and today you're managing close to 2100 crores. The track record is also very enviable. I mean, it's a space which has been pretty headwinded and there have been a lot of challenges. So I'd like to gather your thoughts on how this journey has been for you and what has worked.
Thank you. Thank you very much. First of all, I'd like to thank you, the entire wealth management and our investors who have supported us in last 5 years. So I joined here in early 2013, so I'm completing 5 years, and from a sector perspective, probably not the best 5 years in last 20 years of my working experience, but there is always an opportunity. When you are into investing business, you need to find opportunities to invest. If you see the way we have gone about looking at the real estate market, we have largely focused on residential market. We largely focused on doing business only in top 6 cities. And when I joined here and we thought of scaling up this practice, we looked at the environment and the environment looked tough. And we were of the view that the environment will get tougher. Bulk of the risk that people used to associate from an investing perspective, they used to look at approval as the key risk. And that was the environment because of the policy paralysis that the industry or the country as a whole we were facing between 2010 and 13. We were of the view that the goalpost has changed from approvals to sales. And sales are going to be the key risk in this sector. So we went about building our practice around 5 principles. First, goalpost has changed from approvals to sale, mitigate the sales risk. Approvals continues to be a risk, right, but not a towering risk that people were perceiving it to be. Second, we were of the view that RERA, a real estate regulator, would some point of time will come into the place. It was not there in 2013, but during the fund life there was a large possibility, and which will clean up a large part of the unorganized real estate developers. So do business only with large, meaningful, dominant players. Third thing, there was too much of oversupply towards luxury. We focused only on affordable housing. I know the affordable housing has become cliched now and everybody is talking about affordable housing. We looked at affordable housing as a mid-income housing, middle-class housing, which are the sales prices outside Bombay is between say 4,000 to 5,000 rupees a square feet, going up to 5.5, 6. And in Bombay less than 14,000 rupees a square feet. Fourth, we said we are going to stay away from Delhi and Bombay. These were the markets where there was a lot of froth because of speculation that had taken place. And the fifth, which is the core of this business, is asset management. If anyone does armchair management, give money to real estate developer and think the developer is going to make money for them and make them rich and their investors rich, it doesn't work that way. Right. So you need to be actively involved, engaged with the developer on a regular basis. And I think these 5 things is a combination of it. Like one thing that my investing skills have sharpened here, speaking to the people on the investing side on the equity, that you don't have control over the outcome. What you can have control over the strategy and process. So we have stuck to our processes and been very true to the strategy that we have chosen to do.
Wonderful. Just to draw from your thoughts, I remember in 2012 when most of the fund managers were looking at giving debt to real estate developers, you had a slightly different thought, yeah, and that has played out quite well. Yeah. Can you tell us a little more about what you foresaw at that time? Yeah. And obviously we know it's worked very well.
Yeah. So actually when the fund managers or the larger industry was looking to do only post-approval senior secured debt, it was because of their fear towards the approval risk. And I agree with the people who were practicing at that point of time, because the approval risk was non-measurable. The predictability around time and the cost was just missing. We looked at it a little differently, because in our mind we were thinking that we looked at it as that approval risk is going down. Also, we looked at, if we want to do business with large established developer, where is their challenge? And if you are able to provide a solution towards their challenges, you will be able to create a win-win. Most of you, like, you will be aware that there are regulations which don't allow banks and to a certain extent NBFCs to lend money to real estate developers till the time all project approvals have come into the place. So there was a paucity of capital for right kind of a developer to raise capital towards acquisition, for land acquisition, which is pre-approval. So one big strategic call that we took is that we believe the business should be done with large developer in mid-income housing outside Delhi and Bombay, and provide them a capital at the right stage. We were able to generate almost 7 to 10% of an alpha with the same set of developers by providing them capital when they really need it.
And we know how wonderfully that has played out over the last few years. I believe your fund is online to generate an IRR of close to 21-22%.
Yeah, it's still halfway through. We have done a total of 14 investments from the fund that we raised in 2014-15. We have done 7 full exits so far. 7 more has to go. But what we have exited has generated a gross of 23%. And we believe we are in course to generate a similar kind of return on the balance 7.
So that brings me to my next question. You're in the process of raising your 4th fund. So where is the opportunity today?
So largely the opportunity set and our strategy remains same. Focus on middle income housing, and to our good luck, the government has come with host of benefits and subsidies focusing towards affordable housing. And let me just take a minute out and explain how this time it is different, a focus towards affordable housing. All previous government, whenever they spoke about affordable housing, they always spoke about low cost housing. Any kind of subsidy that used to come for the bottom of the pyramid. Either there will be restrictions around the areas or towards the price. This government, or this time, it's been turned on its head. The affordable housing definition has been restricted only to the size of the apartment. A developer can make a affordable housing at Nariman Point, or in a Bangalore in Koramangala, or in Delhi in South Delhi, and they can still get all the advantages which is coming which are there for the affordable housing. So affordable housing as a theme is something which is for real, and the kind of benefits which have been given to both demand side and supply side, I think is the next growth phase. Where do we see the opportunity? Consolidation. RERA is a watershed event. Like any other sector, whenever the regulator has come, he has brought out scale into the business, level playing field, transparency, customer protection. There would be a teething issues, there will be challenges for next couple of years where the churn will take place. There are just too many developers and the churn will take place. But this is a watershed event where the industry or the real estate sector will get consolidated. It will get scale with consumer getting protected. If I draw a parallel with, say, equity markets, before SEBI came into the place, the capital markets had a different way of doing business. Now 20 years hence, if we look at the way the capital markets are doing, it's very different from what used to happen. It also got a lot of scale to the industry. Same way insurance companies. IRDA was set up in 2000 and it were only public listed public companies, government-owned companies which used to be in this business, and look at the scale it has brought up. So I think the opportunity lies twofold as I see it. I'm not saying the sector is still out of the woods. Last 5 years prices have remained stagnant. It probably will remain stagnant for some more time. But real estate regulator will bring discipline in the sector, will bring in consolidation, and the affordable segment where the government has a lot of thrust will throw up opportunity. So for us, we would like to put our capital behind consolidation and continue to focus on our core 5-point strategy.
I believe, the last fund was basically giving mezzanine debt to developers, and when you had launched this fund, it was quite unique in the sense that most of the other funds were doing pure debt. I understand that you've tweaked the structuring again in this 4th fund. So could you talk us through that?
Sure. So fund 2, when we did, which was a 500 crore, and then we followed it with 1000 crore fund 3. In Fund 2, we largely did mezzanine, which is downside protected land acquisition money, but structured in nature. We still did structured equity. We did one transaction, so 13% post portfolio was structured equity. That structured equity portfolio was taken up to 25% in Fund 3. We believe this is the most opportune time to actually do more structured equity. So this time round, we are making it 50-50. Rest of it remains same. So once we have got our groove in terms of our strategy and processes, what we are tweaking is we are upping the allocation towards structured equity. Now the question that comes is why structured equity and what is a structured equity? Why it is structured and why not it's an equity? We see a lot of opportunities over the next 2 years in consolidation. I would not use the word distress. I'm not saying these are bankruptcy cases, but I believe there will be a lot of opportunities where the consolidation will take place and would leave value on the table for the incoming developer, and along with that the investors or the fund that come along. We would like to capture that opportunity, and we are in the midst of 3-4 such transactions. One more learning working in this organization where the investment skill have sharpened. Save as much as you can at the time of buying. Whatever you, when at the time of buying, if you have built the buffer, it will come handy while taking the money out. So I think equity or structured equity is from that perspective. We'll continue to do debt structure because the industry, the developer requires both kind of solutions. But I think structured equity is something which will play out very well with a horizon of 5 to 8 years from here. Maybe 2 more years, we would see challenges around or challenges of regulator, challenges around sales. But with a 5 to 7 year horizon, I see real estate sector completely changed. And if we are going to be with the developers who are going to be beneficiaries of RERA, it will pay off to our investors as well. Why structured and not pure equity? There could be transactions which could be pure equity, but our idea is that some of the risk which we take in pure equity transactions, we would not be taking here, like the completion risk. Or some of the transactions we don't get into the cost with the developer. We align ourselves to the top line. That's where we are not going full hog doing pure equity, but somewhere closer to it.
For the benefit of our investors, could you elaborate a little bit on structured equity and how you're mitigating some of the risks?
Yeah. So in real estate, if you have to look at it, there are primarily 5 risks. When you acquire a land, you will have title risk. Then you go for approvals. There could be approval risk. Either they can be denied or they can be delayed. Then you have construction risk, where the cost can get escalated or the timeline could get stretched. And then there is sales and the velocity and the price risk. And the 5th is the regulatory risk which have been added. In our experience here of 5 years of doing 38 transactions or our last 18 years of experience, when institutional money is invested, when a developer, large developer is buying a land, title issues are last to come by. The kind of diligence that takes into place, I am not seen any transactions facing title issues. Second part, I've already addressed the approval part. There is a fair bit of predictability. I would not say that we can walk into an office and get out with an approval, but there is a predictability in most of India now, wherein we can predict what kind of a timeline it will take and what kind of cost which is involved into such kind of approvals. The risk which is still open is the sales price and velocity. That's the risk that we are ready to take in a structured equity transaction, because our belief is that for last 5 years, the property prices have remained stagnant. We are reaching a point where we have hit the bottom in terms of price correction, and there will be a recovery cycle over a period of next 3 to 5 years, going up to 7 years with the right set of developers. That is the risk we believe now. If you see 2013, I said the sales is the key risk. Now I believe now we will have a surprise on the velocities, though price rise would not happen. Completion risk is something that we mitigate along with developers. That's where we want a safeguard. So if you really see of all the risks which are there, if you are with the right set of developers, it is worth taking sales price and velocity risk. It will pay off. And a mezz or a debt kind of a transaction would pay anything between 17 to 20% kind of an IRR, more closer to the lower band, wherein equity transactions would be more closer to between 23 to 25. So you are getting risk adjusted higher return as well, along with a larger multiple.
So what is the size of the fundraise and what are the approximate IRRs that you're looking to generate through this
So
fund?
we are hoping to raise or targeting to raise 1,500 crores.
Right.
First one was 500, now 1,000, and then we are looking at a 1,500 crores. The targeted IRR for doing a mesh structure is between 17 to 20. One should take it as like an 18% IRR. An equity transaction between 22 to 25, hoping to have at the higher band of it. A blended IRR targeted around 22% is what we are looking to make.
Right, right. Wonderful, Sharad. A lot of our investors are also invested in real estate directly, and many of them are looking to buy their own houses. Any advice for them?
So I have a strong opinion about how people have gone about speculating into residential real estate, and I happens to meet a lot of investors through you or through our other partners. Most of the HNIs or investors are deep neck with lot of physical real estate holding. My advice to them would be their real estate allocation has to have three components. First, residential real estate for consumption. One can have more than one real estate for the family or future needs. If they still like doing physical real estate, it should be rental bearing asset, preferably a commercial, and any other allocations towards real estate should be through alternates indirect route. So it's a good time, maybe next 1.5 to 2 years will be a good time to pick up an asset for self-consumption. Prices are not running away, but this is the time when you will get your deals. It's a buyer's market. As far as speculation in real estate and trying to make money through physical real estate, gone are the days. People have made abnormal return between 2002 and 2012. It's been static for last 6 years. It'll probably remain like that for next 3 years. And the abnormal return is getting a mean reversion. I would also like to add, in long terms, both equities and real estate has given returns between 12 to 17%. People have made abnormal returns speculating into physical real estate, which was in upward of 30%. That is not possible. From here, whatever returns we made between is getting averaged out. So I would highly recommend investors to stay away, and even if the deals look very attractive, and you will have all kind of deals coming their way, subvention scheme, don't pay anything, pay 90% on possession, I would still urge to stay away.
Great. You had a varied experience before Motilal Oswal. You've been on the lending side as well. Any experiences that have helped you in your investment journey? Any insights that you'd like to share with our investors?
So, like I've heard from you only, and some other grounds up approach of a bottoms up for buying equity stocks, and that works here as well. Unless until you have worked at the ground, you have worked with the developers bottoms up, which would mean, see, the key risk in this business is two. One, getting the right entrepreneur. Second, ability to understand the market. Unfortunately, this industry is opaque. In equity markets, you can open a terminal, you can read 1,000 reports, you can read balance sheet. This sector has opaqueness about it. And you would be able to go past that only if you have spent time. The second thing, you need to have an ability to speak the same language what the entrepreneur or the developer speaks. Do things which he understands, keep it simple, and try to find a win-win solution. So I have learned it over a period of time that knowledge in this sector can only come by spending time. Unfortunately, you cannot go and read a book or a research report which can give you that insight. So you have to go through that grind and get the right entrepreneur. Once you have got right set of developers, try to grow along with them.
Thank you very much, Sharad, for sharing your valuable insights on real estate, and wish you all the best for a successful fundraise for IREF IV.
Thank you,
the fourth
Ashish.
real estate
Thank
fund.
you for your time. It was a pleasure. Thank you so much.
Thank you, investors, for listening to this edition of Know Your Fund Manager. There are some valuable insights which I've picked up from Sharad today on the real estate sector. The three topmost which come to my mind are people, processes, and performance. So processes basically tell you that focus on the process, not the outcome. Real estate is a sector where you need to know the sector bottoms up. You can't read a book and suddenly become an expert in real estate. Second, people, like Sharad said, he invests in the right entrepreneurs, and that leads to success. And lastly, but not the least, performance, the long-term track record of developers in building projects and delivering is very important before you back them up. If you have any queries or feedback, please write in to us on our email, send your suggestions on our Twitter handle or our Facebook page. Thank you very much for listening today.